Welcome back. Let's put the spotlight on banks. Nomura in a recent report says that the debate around deposit mobilization and high LDR ratio has shown no signs of abating. They are adding the argument that banks are unable to mobilize deposits is misplaced. To discuss this and more, we have Param Subramanian, Vice President Equity Research at Nomura, now joining in. Param, good morning. Great to have you with us here. Thank you very much for your time. So, why don't you begin by making the case when you say that they are unable to raise deposits? I mean, obviously you can raise deposits, but if you pay out more, right? I mean, at some rate you'll be able to raise deposits. Is that what is happening? And if you can give us a sense, so compared to FY22, if you take all banks in question, public, private, everything, the amount of loans that they all made, I think it was about 23 lakh crores. Will we in FY25, will that number be lower? Or are you assuming that absolute number to actually go up? Your thoughts?
Sure. Thanks, Prashant. Thanks for having me here. So two key points that we want to highlight. Of course, there's been a lot of discourse around deposit mobilization for banks. Now, what we want to highlight here is that the main two reasons for deposit mobilization being lower, loan to deposit ratios relatively looking higher. Firstly, if you look at the money creation by the RBI, what is called the reserve money often, that has actually been very low over the last 2 years. It's only been about 60,000 crore accumulatively over the last 2 years, compared to about 6 to 7 lakh crore on average per year in FY20 to 22. That is one of the bigger reasons for deposits in the system looking lower. The other reason is a bit counterintuitive here. It's that the higher profits that the banks are generating right now, the banks are generating about 1.7% system level ROAs, and ultimately the profits of the banks are appropriated from the depositors. So when the profits go up, the deposits do see some shrinkage, and the real ratio one should be looking at is loans divided by deposits plus the net worth of the banks, which is actually largely in line with the 10-year average. So this whole discourse that banks have some struggle in terms of deposits is actually not very correct. One of the key reasons, like I highlighted, is actually how the
I think we lost the line there with Param. We'll just sort of try and have him back. We got a fair bit in terms of some of the reasons that he was highlighting, but we'll just try and have that line back up with Param in just a bit from now.
I guess one of the key points that he's making is that money supply hasn't increased as much. I mean, that is still fairly muted. So then the argument that there's a massive sort of hunt for deposits, perhaps it doesn't quite add up. But let's see when we get him back. The whole point is that quarter after quarter, we keep seeing the reported numbers. And that's where there's either zero growth or lackluster growth, or sometimes, no growth at all. And another telling factor is that CASA ratio for most banks in the first quarter has been slipping, both quarter on quarter and year on year.
And you talk to banks, they all say sometimes on the record, sometimes off the record, that there is you got to sort of work on deposits and deposit mobilization, etc. But Param was making some interesting points, and unfortunately the line went off.
I mean, even the finance minister kind of acknowledged. I remember in her meeting with bankers, which happened, I think, just last week, saying that banks need to look at more innovative ways to retain deposits and sort of get customers back. But I don't know. Do we have Param back?
Yeah, we have Param. Param, go on. We lost you there, but please, I mean, we heard. You were midway, so please continue and finish that point.
Yeah. So firstly, one of the bigger reasons for deposits lagging loan growth in the system over the last couple of years is actually the pace of reserve money creation by RBI has actually been very low compared to the period before that, the COVID period, when so over the last 2 years, RBI only created about 60,000 crore of money supply on its own, versus about 6 to 7 lakh crore on average created in the period between FY20 to 22. That is actually one of the reasons, and this is a central banking action, and it's not something that banks can do much about. The other reason I was pointing out is that when banks generate higher profits, the profits are ultimately appropriated from the depositors, and so higher profits have the effect of reducing deposits at the margin, and this is something, as we all know, banks are going through a very good cycle and are generating high ROAs. That is also putting some pressure on deposits. There is also this discourse that money is flowing into capital markets, into mutual funds, which we think is misplaced. It doesn't have any impact on system deposits. The only leakage from money supply to deposits is cash in circulation. And if you see over the last 2-3 years, cash has only been growing at single digits over the last 2 years. So that is not a systemic concern. We think that once we move into an accommodative sort of policy and liquidity in the system starts picking up as a consequence, with RBI, say, being more accommodative, deposit growth should start picking up, and we should naturally see LDRs at a system level coming down.
But you know, while we take that point, Param, the counter question that really comes to mind immediately is that the RBI itself has been cautioning against credit growth running away and deposit growth not keeping up pace, right? I mean, it's not a written down rule, but the understanding very clearly is that the credit deposit ratios have to move to a more sustainable level. No bank, I think, talks about a specific number, but everyone agrees that yes, the RBI needs it to be in a certain healthy range. So if that is to happen, and while deposit mobilization picks up and rate cuts happen, are you expecting a drop in credit growth in the meantime? When do we see the balance coming back?
No, you're absolutely right. So the policymakers have clearly made it, a key focus area that loan to deposit ratios need to come down. We've also had RBI come out with a draft LCR circular that in some way enforces this, that brings LDRs for the system down. And until the policy environment and you see the powers that be continue to talk about this, of course, you will have to see credit growth moderating for the system, especially for some of the higher loan to deposit ratio banks. They will have to see loan growth moderation. From the current 15% odd system growth that we are seeing, ex of HDFC that the system is reporting, we actually think there will be some moderation going by the end of the year to about 13%. But the key point that we wanted to highlight is that this is not a systemic concern that deposits are not coming through. It is more a cyclical phenomenon that will correct itself.
I mean, Param, if you look at ECBs, right? I mean, just one of the data points. A lot of banks, actually more NBFCs maybe, they're raising money through ECBs from the beginning of the year. I think the pace is almost double of what we saw for the same period last year. Isn't that a sign that, deposits are hard to come by?
So if you look at the quantum of those numbers, Prashant, they aren't as, from a system level perspective, you have to put it in context of the fact that a system level deposit number is about 250 trillion rupees. Of course, we're seeing ECB mobilization pick up, and it's more a non-bank phenomenon or a corporate phenomenon. But it's not a clear indication. If we stack it up against, say, the net worth generation by the banks over the last 3 years, it's been about 6 to 7 trillion rupees over the last couple of years. The banks are actually, strengthening their balance sheet because the profits are coming through and actually bolstering their CET1 ratios. They have the ability to lend. The constraint is not, very significant at this point in time. But if you have the policymakers talking about this, naturally they will have to abide by this, and the loan to deposit ratios will have to come down.
Param, just to wrap things up, two specifics. One, by when do you expect the problem to resolve itself? Basically, by when do you expect deposit growth to start showing up, number one? And number two, and this is not a stock call question, well, you mentioned that credit growth will have to come down for banks where the credit deposit ratio is too high. Just some names, and again, not related to the stock price, but just some banks which will have to see a moderation in the credit offtake.
Sure. So deposit mobilization, I think at a system level picks up around the time of we move to an accommodative sort of policy stance from RBI. We would think that, once we move into, say, rate cuts gradually, RBI will bring liquidity into the system. It will want to transmit those rate cuts, and the natural way to do that is to push liquidity into the system, and that will, have a consequent positive impact on deposit mobilization at a system level. So we'll have to watch out. Of course, at this point in time, we are early in that cycle. We'll have to watch out. But I would think around the time rate cuts begin, we would start seeing that. The other point you were asking on growth moderation. Look, it is well understood. Some of the banks, for example, example, HDFC Bank has clearly talked about a moderation in its loan growth outlook, and this is well understood. It is a transition period, as the bank has called out, and we should think that over the medium term, once they get this in order, things should be back on track for them as well. Yeah.
All right, Param, we leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC TV 18.